we have other buyers that essentially give the seller what they're looking for, and the deal still doesn't close because the buyer was all about the deal.
Price is a very important part, right, of the equation. But I genuinely do think and have seen firsthand that for 90% or more of sellers, it is about fit first. There are enough buyers out there that are willing to pay fair market or even a little above fair market, in some cases, a lot above fair market, to acquire a practice.
Welcome to Advisor Talk with Frank LaRosa, brought to you by Elite Consulting Partners. It's the only podcast offering unfiltered guidance and the direct advice for all things concerning financial advisors, RIAs, and the practitioners in the wealth management business. And now, welcome to the show.
Hey everybody, welcome to Advisor Talk with Frank LaRosa. I am your host, Frank LaRosa, and joined by a very special guest, a Barron's, top 5 advisor, Jon Kuttin. Jon Kuttin is Kuttin Wealth Management, which is the largest advisor franchise owner at Ameriprise by, I just say by a multiple, not even close. And I've had Jon on the podcast before, but today we're going to get into the weeds on some M&A stuff. So I'm sure this topic will be great for everybody. So get ready to take some notes. Jon, welcome to the show. How you doing?
I'm doing great, Frank. Thanks for having me back. It's rare that I get back twice, so this is special. I must have not done quite as bad as I thought the last time. But in all sincerity, losing my voice a little bit today, but glad to be back. Thanks for the kind words, and I'm ready to dig in, man.
Yeah. So why did I bring you back? I bring you back because a lot of times we look for guests that are experts in a certain area, and there's lots of things that you can talk about, and a lot of the books over on my shoulder that we read, we both read, and actually the Who Not How one is, I think, your recommendation right out of the gate. So for those of you that aren't watching us, you can go to YouTube and you can see two handsome fellas on video talking about what we're doing. So Advisor Talk with Frank LaRosa, obviously. But I wanted to bring you back because you do something that is that I think is you do exceptionally well with our clients. So we have our business. One of our businesses is called Elite Advisor Successions, which is pure M&A, buying and selling advisory practices. And obviously, you're one of our largest clients. But it's not just because you're the size of your company. It's because of how you approach doing business and doing M&A deals. And there's been a little bit of a struggle. I've done some podcasts in the past about how to become a better buyer and what does it mean to be a better buyer. And we get a lot of inbound interest where people say, "I want to be a buyer. I want to be a buyer." And when the rubber meets the road, they just can't do the deal. There's lots of reasons, right? And so I just want to get your perspective and have my audience almost like get inside your brain a little bit in how you approach deals, why you do the deals the way you do them. Because, our experience with you is you don't mess around. Generally speaking, the deals get done pretty quickly. You don't hem and haw and nickel and dime over little bits and pieces of some things. We have some big deals in the works that you really customized to get done. But we've done multiple deals with you this year, more than any of our other clients. And so just philosophically, let me just start at a high level, and then I want to actually go down this path of, you're not paying for these deals out of your own pocket. I mean, you are in a way, right? But you're not paying cash for them. There's some debt service being done, and that's a scary thing to a lot of advisors. They freak out about that. Oh my God, I have to take debt. I'm a financial advisor and I don't like debt and all this other stuff, which is not the right approach sometimes, right? So we'll get into that and how you've. Well, I don't need you to give the details of what you do, but just your philosophies when it comes to doing transactions using debt versus selling part of your business and all that other stuff. So philosophically, when you approach a deal, we bring you $1 million practice, right? Tell us, walk through what you're looking for, how you're looking at the deal, and how you approach the deal terms.
Yeah, sure. No, well, the first thing that I would say as we think about things, Frank, is when we're looking at a particular practice, right, we're looking at where and does this practice fit into the organization, right? And when I think about advisors, you said something that a lot of advisors, kind of hem and haw on thinking about pricing and at some point you have to make sure if you're going to be a buyer that your practice is actually set up appropriately to be a buyer. You've got to have some systems, some processes, you've got to have some free cash flow, and you want to be in a position that you can weather a downturn in the market because they do and will come. And we might be doing one right in the next few years. Who the heck knows? So I just want to start by saying that not everyone should be a buyer. And once you've made the decision and you've done the work, if you will, to get your business set up, then I think you have to just put a little bit of a different hat on, right? And what I mean when I say that is there are, I will say hundreds now. I used to say 50, but there's hundreds of advisors that want to buy businesses, practices, right? And there are not quite as many sellers. So they're hard to find. And that's why I partnered with a firm like yours, Frank EAS, to help with the sourcing. So once you are actually able to meet right, a legitimate seller who is truly ready to succeed their business, whether it be immediately as a full sale or whether it be over a few years, a sell and stay or different optionality. To me, it just really starts to become a why are you doing it? And I'd say I probably identified, Frank, that there's usually three reasons that advisors are looking to acquire practices, right? So one is just simply to get bigger, right? They're looking to actually grow their own gross production and their profitability, their revenue stream, so on, et cetera. What I would say is most advisors listening to this, the reason that they want to acquire a business is to actually make more money next year. And we'll circle back to this. That's probably not possible today based on all of the competition from institutional investors and private equity and all those things, the way it once was. Maybe you've got a buddy in your office or someone you've known, and you kind of get the first right of refusal on a deal. But once a seller brings it to market through an organization, Frank, like yours, or any of the other organizations that help sellers find buyers, you're going to expect to pay fair market value for the business. And fair market value for the business is no longer, I'm going to pull hundreds of thousands of dollars of free cash flow out 12 months later. And we can circle back on that if you'd like.
Yeah.
So that's the first reason. And I'd say it's probably not the place that 90% of the buyers today that are successful, that's not why they acquire the business, right? It's not to
Right.
make more money next year.
Yeah, they already have the money. They're a $1 billion practice or more, and they're not trying to make an extra $100,000.
Exactly. And that's who you're competing with. If you're a $200 million practice doing $1.5 million of gross and you take $1 million home, but you spend 700 grand a year for your lifestyle, the problem is, right, you're competing with 300,000 of free cash flow pre-tax, where your competition might be someone like my firm who manages almost 15 billion of assets that has a lot more free cash flow and doesn't need to be profitable next year, right? So, and I'm
Yeah.
just, it's a piece of education. So the second piece I'd say is what I call, an I can't say it, an acquisition, which
An
means
acquisition. Yeah.
you're doing it, one, because it's a great practice, but two, because there might be some great talent. And we know there's a talent shortage in our industry inside of the business that you're buying. So you might look to acquire a business because they've got two great junior advisors that the gentleman or woman who's selling the business might not have done the greatest job of turning over the reins to that junior advisor, but you're a better leader and you can actually take those junior advisors and put them to work, maybe in your own business, as well as in the business that you're acquiring. And now all of a sudden it's an acquisition, but the talent that you're actually acquiring might be the most attractive part to it, right? So again,
Yeah.
you're not necessarily doing it because you're making money in the first year, but you're attracting talent, which is effectively kind of like a stepping stone, if you will, to where you're trying to head. And then I'd say the third, and this is how I try to look at acquisitions, Frank, is it's really more around how you're building your enterprise and how you're building your enterprise value. And you're starting to put on a little bit of a different lens. And I'd ask for our listeners to dig in on this, right? Where you start to look at it and you go, I have some balance sheet capital, or I built a business that's worthy of now getting debt from a bank, right? As an example. And you're starting to enter a phase of just simply understanding leverage. Okay. And leverage, when you think about institutional investors and private equity, and for that matter, publicly traded companies, what they are is they're really good stewards of their capital and they understand leverage. And leverage sometimes is a dirty word, like you said. Advisors don't want to take on debt. But when you think about it, it's no different. And the best analogy that I give when I speak sometimes, it's like real estate, right? When you think about a lot of the wealth in our country, it's been built by either business owners and entrepreneurs or real estate investors who are also usually business owners and entrepreneurs. But how do you build wealth with real estate? You buy a commercial property for $10 million. You put 20% down and you go borrow, right, 80% or $16 million, a lot of money to go borrow. And then you have tenants who pay you back rent. And over time, you pay down, right, that $16 million loan. And the hope is, and it's a hope, doesn't always happen,
Yeah.
real estate or the wealth management business is that the 10 or $20 million commercial real estate that you acquired becomes a 21 or 2 or $5 million business. And because you have $16 million of debt out there, you're actually getting a return on that leverage, right? So, kind of an extreme example, but when you think about how you buy an enterprise, if you're a bigger firm on the independent space, which I assume most of your buyers are, Frank, then you get a multiple, right, increase sometimes by just simply having more scale and getting bigger. And then the secondary part of it is you're also in a position that the cash flow that you're acquiring from the business, as long as you can run it as effectively and in many cases more effectively than the person you're acquiring, you got to be a good operator of the business. Then what actually happens is you're using their cash flow. I know this is simple, but you're using their cash flow and you're paying down the debt, whether it be on a seller note or whether it be on a note to a bank, right? As an example. And every year, although you're not actually creating a lot of, and maybe no free cash flow to your net, to your bank, your personal bank account or your corporate bank account, what you are doing is if you have a 10-year loan with a bank, you're paying down 1/10 of it on average, right? Of principal, obviously less in the beginning because of the interest payments, but you're increasing your net worth. And I think I'll give you the conch back, Frank, but as I think about being a buyer and you think about those three different reasons, you have to determine where are you in your career today, right? Which of those three big criteria or reasons are you actually thinking about buying? And then once you understand it, at the end of the day, you'll know which are the right deals. And quite frankly, whether or not you should be, because I think there are some folks out there buying that shouldn't be buyers, that they're not ready for it. But whether or not, if you've made the decision that you should, you get to figure out kind of, where the actual opportunity is for you in acquiring the businesses.
And do you have to, when you talk about building enterprise value, what if the advisor says, well, I'm not really looking to sell my business to, when they hear enterprise value, they feel like, oh, okay, sell it to a PE firm, right?
Mhm.
How does that philosophy change if they are like, well, I don't want to sell to a private equity firm, so I'm not necessarily concerned about enterprise value?
Yeah, great question. I look at it this way, and I acquired my first practice in 2002, so it's been a long time, and I've literally done north of 100 acquisitions, right? So I again, for whatever reason, I must have real estate on my mind today. It's no different than if you've had the opportunity to buy a house, right? This is literally how I now look at it, 20 plus years later, and go back, right? And I could tell you. I bought my first house for 300 and I think it was $13,000. Was that what it was? Let's call it $313,000, right? I held it for about 9 years. and I sold it for $890,000. And I initially took, I'm making up numbers here, about a $250,000 mortgage. And by the time I sold it 9 years later, the mortgage was like 180, right?
Right.
So I had the pay down of the mortgage and then I had the appreciation, right, of the business. And I think it's the same thing, Frank, right? Which is um, if you think about it this way, if you can take another advisor's 30 years, blood, sweat, tears, building that business. I always say sit in the kitchen tables, right? Having a dog eat your shoes. And those of you who've been around a long time remember those days.
Yeah.
Um,
When you
and
said it was
then
okay, meanwhile, it was the only nice pair of shoes you had.
yeah, exactly right. Yep. You had to go shine those suckers, didn't you? But you're getting to take that individual's 30-year plus career, right? And by you're taking their recurring revenue in most cases and their cash flow and the goodwill that they built, and you're able to take that, right? And then call it over a 5 to 10 year period of time to have enough cash flow to fully pay for this acquisition and use the profitability or EBITDA that they have in the business that they own, because most banks will give you credit. So you could borrow against the business that you're buying as well and what their EBITDA is. What should happen is if you're a good operator of the business and the markets are neutral or hopefully slightly positive and don't turn against you, that's where the risk is a right a big turn in the market. But at the end of the day, Frank, you should have an appreciating asset, you should have appreciating cash flows, and you should have a fixed expense that eventually goes away. And just like a mortgage, once it goes away, that whole business is now free cash flow.
Hmm.
So it's also a great way to increase your income and your earnings, and you have a bigger referral base and all the things.
So, do you advise to pay down that debt as fast as possible, so that you, right, if you're using that, or do you keep your powder dry for the next acquisition?
Yeah. So listen, I'm a big believer, Frank. And again, I'm kind of taking you through the cycle, which is depending on who the listener is, right? I always call it there's a core I call it the corridor. Okay. And I made this up on my own, I think. Usually I steal stuff, but I think this one's actually my very own. The corridor is to be able to look at your own personal situation, right? So if you're an advisor today and you have $1 billion operation and you've got $3 million of profit, just as an example. If you spend $2.8 million a year on your personal life and you make $3 million a year, if you do an acquisition and the markets turn and you've got debt, you might be in a tough spot. That makes sense?
Yeah.
You could be the same advisor who has a $300 million business and has a $1.5 million profit, and you live on $500,000 a year. Well, now you have $1 million worth of free cash flow, right? You can actually deal with a downturn in the market, right, and not be as affected. Liquidity is another big piece, right? Do you have savings on the sideline yourself, personally, or on the balance sheet of your company? So and the reason I share this, I was acquiring businesses in '08, and I remember thinking I was going to go out of business after acquiring a business, right? So you want to be prudent and you want to give the same advice to yourself as you would to a client. Don't take more risk than you can afford to. But the truth of the matter is, just about anyone I know who's acquired businesses took a risk that probably in hindsight was riskier that they should have when they acquired a business, and they just worked like mad to make it work.
Right.
And then what they did is they didn't adjust their lifestyle and they kept their overhead low enough so that they can go do another one and another one and another one, right? And the more advisors you talk to who've been serial acquirers, that's what you ultimately find. Um, but to answer your question, back in the day, I financed as much as I could for as long as I could, right? So if a bank would give me 90% financing, I take 90% financing, 10-year amortization, right, which is about as long as most banks will do. There are banks out there now that will do EIO, interest only for some of it. So there's a lot of creative ways, right? And then it becomes you're a steward of your capital. So depending on where you are personally and professionally, how do you continue to keep your debt at a reasonable place so that you are ready to do that next particular deal, right? So like today, Frank, if I go back 5 years ago, I would say we pretty much did almost all of our acquiring based on taking a loan from a bank and seller financing with very little cash, right? Today, we're in a much better cash position because we've been good stewards of our capital, and we try to put 40% cash down on a deal, 40% bank financing on a deal, and then 20% on a seller note. That makes sense to everybody, right? And
Right.
that what that does is it actually reduces the risk because we've got less debt out on the street because we're paying for 40% of the acquisition cost in the form of cash.
Yeah, what I see a lot of advisors trying to do is they're doing a deal and they're trying to, they're putting 20% down or 30% down, meaning they're down to the seller. They're using a seller's note for the remainder of it, so it's all debt. What they don't realize is that the bank generally wants you to put down some of your own money, 10 or 20% of your own money on the total deal. So advisors think like, well, wait a minute, I didn't know I have to put down any money, and then they blow these deals up. But it's interesting because look, when buyers come in, you're the guy they're competing against, right? Literally and theoretically sometimes, right?
Sure.
And so I think that's what they need to understand on how these things are structured. What about just shifting gears for a second? Because when you talk about buying the right practices, and I don't know how you feel about this because we have not talked about this, but I feel like if I was a buyer today, everybody's like, I want $1 million practice that 80% advisory, and the seller wants to leave within less than 12 months. And I'm trying to tell people that you're paying a premium, like you're fighting with the big dogs for that book of business.
Mm-hmm.
Drop down, look for small, especially at the beginning, right? If you're a multi-billion-dollar team like you, but even still, you've done some smaller deals, right? But drop down and go look for those businesses that are 50% advisory, because the advisor is probably tired, right? They're not really working the book of business. It's maybe they got $50 million, but there's probably $80 million out there because the advisor doesn't want to work the business because the transaction side of the book is wearing him or her out.
Yep.
Do you
Yeah.
view that as an opportunity, or do you think that it's a waste of time?
No, I think it's a big opportunity. I think both work quite well, right? I would say the best ROI, right, that I've been able to get on the capital I put out has been on a fixer-upper like you're describing. An advisor who's old and tired and is still kind of in the transactional days and isn't winning outside wallet share. I mean, we've had experiences, Frank, where we've earned all of our money back in like 18 months. I mean, literally, we've come into businesses and it's a little 80 or $100 million practice that's doing 450 a year in gross, and you go in there and you could just tell that that advisor is just doing the bare minimum, and you get in there and before you know it, you double the AUM, you move to your model, right, of working, planning, and advisory. And I feel at least that there's less and less like that out there. There's some, but those are becoming less frequent. And more of the deals that are being done, at least in our practice, and for those that I know, are generally, I would say better run businesses where the ability to really, double or, get 30, 40% increases in revenue is a little bit harder to do. And I would say a couple of things, Frank. I want to go back to some of the debt because I think it's an important piece that advisors don't understand. And I think you call that a really good point before. Um, when I think about an acquisition, we are generally with a 10-year amortization with the bank financing portion, right, of the transaction. We're generally looking at about a 5% rate of return after the tax benefits of capital deployed. So, said a different way, if the total sales price for $1 million practice, right, was 3.5 to $4 million, which is about what they trade for today for a well-run
Yep.
recurring revenue business.
Yep.
If I'm putting 4 million of proceeds out on that $1 million top line business, when all said and done, after the tax benefits, the amortization, the interest write-offs, right? Obviously the expenses to run the business, On that 4 million out, I make about 200K of cash flow year one. I'm going to say it again. 4 million out, 200K of cash flow, which is taxable, by the way, right?
Right.
Actually, my equation, that's more like a tax-free return. So say of real like money that hits my bank account. If the market drops 10%, effectively I'm break even. 20%, I'm losing 5%. 30%, I'm losing significantly more. So I don't think it's for most of those businesses, is what I'm trying to impress here. It's a cash flow opportunity. Where it gets good is when the $1 million business, here's what I do if I was a listener. If you were a $1 million producer 10 years ago, what do you do today? Or if you were, or if you do a million today, my guess is 10 years ago, you were doing three or 400,000, right? So the reality of it is you make your money by growing the business, right? By hopefully having the market appreciation and the organic growth you hit at the right time, right? And then what happens is your 200,000 of free cash flow turns into 250 and then 350 and then 500. And then all of a sudden you can use that extra free cash flow, right? That's the biggest benefit of it, Frank, is now you have more free cash flow to be more of a true business owner. And you've got free cash flow to make the right hires or
Yeah.
invest in marketing or invest in your next practice acquisition or, who not how, right? Hiring your next who to run your BD team as an example, or whatever is next in your practice. That's what I think happens. It forces this growth trajectory that makes you recreate yourself and go from being a practitioner who works with clients to a little bit more of a business owner. And you and I have talked a lot about these things, where you're actually in the leverage phase. You're leveraging capital and human capital, and all of those things. I want to go back real quick, and hopefully that part just helped the audience. But I want to go back to think about debt a little bit, right? So I am not a banker, but I do work with bankers, and what I can share is the way a bank, you've got different types of financing, right? You've got SBA loans, which are a whole different animal, right? Which come with personal guarantees and things along those lines, and there's limits to them. So I'm not going to talk, and I'm not an expert in SBA, but I will say I started the first business I ever bought that was not on a seller note, started with SBA financing because my business wasn't ready yet to get traditional financing. Okay. But the way a bank is going to look at your practice is they're going to go, let's say you have a million of EBITDA in your business. Okay. And if you're not making, I hope you don't mind my saying this, Frank,
Okay.
if you're not making $1 million a year in profit, you probably don't become an ideal client for Elite Advisor Successions, Frank's company, because it becomes hard. It doesn't mean you can't, right? But it becomes hard to be able to compete with the rest of the world on opportunities.
Yeah, especially on bigger deals, which is what they all want.
Yep. So, but if your practice makes $1 million a year, the bank's going to look at it and go, well, Frank, you're an advisor, you make $1 million total, but you also need to support your family, right? So what's your mortgage? What's your car payment? Tell me a little bit about your lifestyle. Okay, great, Frank. You could live on about, let's say, just for ease of math, $400,000 per year. So the bank's going to then go, fantastic. We can take 600,000 of the EBITDA of the business, and we would be willing to lend you money. Okay. And what most banks are willing to do is they're willing to lend at about a 3 times multiple of EBITDA. So if you have 600,000 of EBITDA above and beyond what's necessary, you
Yep.
got strong, you've got good credit, you're a good citizen overall, you have 1,800,000 to go make a down payment with, right? Or to go finance. And most banks right now are going to be SOFR, right? The SOFR 30 rate, plus a 3.5 to 400 basis points, would put you in the high sixes right now, 6.5, 7% interest rates. Who knows? But seem like they'll likely move down as of the recording of this. They've started to a little bit.
Yep.
So if you think about it in those terms, what they'll also generally do is they'll give you, and this is really important, advisors don't understand this, they'll actually give you credit for the business that you're acquiring. So let's say you're again, in my example before, you got 1 million of EBITDA, which probably means you're a $2 or $3 million gross revenue firm, right? And now you want to go buy a firm that does 1 million of gross revenue that has 600,000 in profit. Well, now the bank looks at it and says, You are making 1 million in your primary business. You need 400 to live. You have 600 of free EBITDA. The business you're buying, well, you're going to take out the owner of that business. And when she or he retires, you're going to get a whole nother 600,000 of EBITDA. So now they look at it and they go, you're a $1.2 million EBITDA candidate. They'll likely give you 3 times on the 1.2. So now you have 3.6 million of borrowing power, right? And if you think the average down payment on a practice these days, in my experience, is going to be somewhere in the 60 to 70% range of cash at close, right? Some more, some less. But let's just call it 2/3 cash at close, right? If you've got the ability to have 3.6 million of borrowing power, doing math in my head real quick, you could acquire a business that does about 6 million of top line revenue. That makes sense to everybody. So
Yep.
6 million of top line, I'm sorry, 6 million of valuation is what I meant to, of gross
Right.
value
Deal size,
of
right.
deal size, which really means you can go buy a business that's probably doing 1.5 to $2 million worth of revenue. I might have messed a little of that math up in my head, but that's how you look at it. And what I'd ask our audience to do is get your financial calculator, right? Or ask ChatGPT these days and just go, if I borrowed $2 million at 6.5% interest with a 10-year amortization, what would the payment be? And it's going to be something like $250,000, $275,000 a year in my head. Um, that when you have 10-year amortization, it's to me, it's your best friend. You could pay it off sooner if you so choose, right? But now you're able to pay a little bit more for a practice and you have a longer period of time to pay it. For
Right.
whatever reason, advisors don't want to do business with a bank. They want a seller note, and seller notes are going to be 3, 4, maybe 5 years tops. And you're going to pay a similar interest rate, but you're going to increase your speed of payment, which is going to make you, to use your words, Frank, hem and haw, because you're going to look at it and go, I'm paying 3 million for this practice. I've got to pay it all back in 4 years. So I got to pay back $1 million plus a year, right? You could take the same $3 or $4 million practice, whatever I said, over 10 years, right? And now you've got a $400,000 or $500,000 debt repay. So you cut your debt repay from 1 million a year in my example to say 500,000. That gives you the ability to say, you know what? Okay, they want 3 million. I get the deal done at 3.2. Is 200 grand going to actually make a difference on a 10-year payment over the lifetime of your career? And the answer to the question is no, but a lot of advisors just can't get out of their own way. And all it is, Frank, is math.
Yeah. And that's where I tell you, that's where we lose deals. Not we lose deals, but that's where a buyer and a seller just they can't agree because we're so close, and the buyer just doesn't want to go that extra little effort because they're like, I'm not paying more than 3x, and 3.2 is over the top for me. Like,
It's
what are you
Frank,
talking about?
it's pride. It's like, you know what? I just had the experience. My wife and I bought a vacation home, right? And I mean, I almost myself walked away from the deal over like $30,000 it was the principle of it that the seller, right, wasn't willing to pay for a repair. And I'm like, there's no way, right is right. And, I cooled down 24 hours later. And I'm like, you know what? It's 30 grand. I'm going to go enjoy my summer home for the rest of my life. What is 30 grand, right? I didn't take a mortgage, but had I taken a mortgage on a 30-year mortgage, right? These days, maybe it's a 50-year mortgage, the
Yeah.
way the world is going. But the point that I'm trying to get at is you're exactly right. Buyers talk themselves out of deals. And when you actually step back and you think about what the payment is, right? What's the annual or monthly payment? And then you always have to put yourself in the seller's shoes, Frank, and go, man, this person spent 36 years building this business, the goodwill in it and the cash flow that it will create forever. Because let's face it, like look at your own practice, everybody. We all run our wealth management businesses at like 97, 98, 99% retention. It's right. And you generally have an increase to your fees as markets go up more often than they go down. It's why private equity can't put enough money into the space.
Yeah. well, that was like M&A debt service, lending 101. I don't know, it was a master
We
class.
call that
I
our
call it a master
101.
class.
Yeah, that's our 101 class.
That
We could move on to 201 now if
Yeah,
you'd
that
like.
was definitely like a master class, but I think it's really well said. Um, and I think the way you're describing it and the way that an advisor needs to look at it makes a lot of sense. Just in the interest of time, just one other thing, and I guess you sort of answered it in terms of like what's it really worth to you. But one of the other reasons why, because we just spent the last 30 minutes talking about the economics of a deal, but you know that a lot of times a seller will walk away from an actual deal that they've asked for, right? Like, all right, here's the number you were asking for, and they go, I'm not going to do it, because there's an emotional side to an advisor selling a practice, right? And you do an exceptional job at making sellers feel like you got this, like selling the story, selling the selling how they're going to be serviced, how you're going to service their clients, and the story about that. Walk us, the audience, through like why that's so important and how you've been able to do that. Because again, we have other buyers that essentially give the seller what they're looking for, and the deal still doesn't close because the buyer was all about the deal.
Sure. Yeah. I mean, most sellers, I think it's a great question, Frank. Um, Price is a very important part, right, of the equation. But I genuinely do think and have seen firsthand that for 90% or more of sellers, it is about fit first. There are enough buyers out there that are willing to pay fair market or even a little above fair market, in some cases a lot above fair market, to acquire a practice. And I've seen folks that have just, chosen us and said, "Hey, you weren't the highest bidder. Your terms weren't the best, but I felt most comfortable that you were going to make and keep meaningful promises and be able to deliver, and you've had the experience of being able to do that." So, I mean, what we've really intentionally done, Frank, and again, this is for the more professionalized buyers or those who want to become more professionalized buyers, is we've intentionally tried to build our ecosystem, as we call it, a safe place for someone to retire, right? And what I mean by that is, do you have the ability and capacity? A lot of times buyers come in and they're like, "Hey, I'm Frank LaRosa and I'm a $2 million producer and I'm amazing and I know everything." And then
Look
you
how
meet
look how good I run money and all that good stuff.
I'm the man. And then they go, "Well, great. I've got 250 clients and you just told me you have 200 of your own clients. So how are you going to work with 450 clients?" And they're like, "I could do it. I'm Frank LaRosa and I'm still the man and I'll do it." And they're like, "No, no, no. There's no way you could do right what I do every day and what you do every day." So having the team in place and being able to serve all of the clients in the practice, I think is really important. And I call it making the intangible tangible, Frank. So as we've put together a pretty nice value proposition that I actually take our value proposition and I present it right to the seller and say, this is how we operate as a company. Here's our vision, our mission, our values, how we deliver advice, our system, our process, our people. And then I have them meet the folks in my team who are going to actually work with their clients. And we've become big enough now, Frank, which isn't, I know not all of your listeners are in this spot, that I can say, meet three advisors. I think they'll all be great. You tell me which one will do the best with your clients, and you could choose, right? And the 80-20 rule prevails in every single practice, guys, right? So the top, 20% of every advisor's business, it's probably not quite 80, but the top probably third of every advisor's business is probably 70 to 80% of their revenue and their AUM. And the issue is, for most advisors, they understand the risk of servicing those clients, but they still really care about the other two-thirds of the business. And you have to make sure that they feel and understand that you value those people as well. Other kind of tricks of the trade, Frank. I'll hit you with like two or three that I think would be interesting for the guests, for the listeners. One, is even though you, as you and I were joking a minute ago, are the best asset manager in the world, and you believe in charging a fee for planning, or you don't, and you believe in stocks or ETFs or mutual funds or SMAs, what I say to every seller is, hey, Frank, whatever you do is exactly what we're going to deliver for the first few years. Be a big enough change for them not to see your smiling face every day. The last thing we need to do is to say, you used to run all your money, in plan A, and now we're going to make all these changes and go to plan B. But Frank, in a few years, where appropriate, we may look to enhance, if we can, some of the services by offering other opportunities. So I'm honest, but we honor that. Second thing is, I'm not going to say, so Frank, you've got 3 staff people and we run leaner than you. And the first thing we're going to do is let go of 2 of your staff people. So who's your favorite one? Because we're just going to keep that one, right? And your real estate's too big and I don't love the decor. So we're going to get rid of your real estate and take space somewhere else. Your clients don't need to come to your office. We keep everything the same. We're going to keep your real estate. We're going to keep your people, keep your investment process. We're going to keep all of those things. And the reason I say that is that seller is nervous about selling. They spent their career building their baby, just like you'll feel one day when you sell your business. And what they want to know is that the clients are going to be taken care of, their people are going to be taken care of, and there's not going to really be an awful lot of change inside of their process. Other piece, and I say this to every seller, um, and I want to say this the right way. There are folks that I've acquired that the only way I would acquire them is if it was a retirement and they were leaving in, say, a year. And the reason for that, and it's an exception, by the way, not a rule, it's probably 10% of the deals we do. I actually don't, I think they're nice people, but I don't think they'd be the right cultural fit for our organization. And I don't think that they are someone that would just be the right fit long term in the organization, right? And that's maybe 10% of the folks, but sometimes we'll do those deals because they still built a great practice. Just
Right.
personality wise, we're not going to jive. 90% of the time, I usually say, hey, Frank, and people love it. Like, by the way, you can stay as long as you want. If you don't want to sell your whole business right now and you want to dip your feet in the water, maybe we buy half now. We buy another 25% in a few years, another 25% in a few years. And you're 62 right now. I mean, maybe you don't want to work till you're 68, right? So how about we build a 6-year glide path for you and you kind of get the dollar cost average out of your business. So we'll buy a piece today at a certain valuation. We'll lock that valuation in. We'll see what it's worth in 2 or 3 years, right? We'll cash you out then for another, say, 25% of your business. And then if you really want, Frank, I know we said 6 years, but maybe we'll give you the option to kick it another 2 years. So if you're feeling good and loving what you do, because I think my team will take a lot of the stuff you don't love to do off your plate, all the minutia and the stuff that I know is hard to do as a solo practitioner. If you then want to take an option 6 years from now and kick it another 2 and stay for 8, I'm totally cool with that as well. Because I want the buyers that are listening in to think about this. What you're buying is goodwill. And if I'm buying Frank LaRosa's business, the clients aren't leaving if Frank's around, right? They're
Right.
here for Frank. And if I have 6 years or 8 years to transition the relationship, like my retention is going to be 100% or 98%. If Frank's out in 12 months, historically the retention is still going to be pretty good. But at the end of the day, that's a much, much riskier set of circumstances. And here's something that I didn't do it this way intentionally. But what you're also doing is you're almost, Frank, you're lining up future EBITDA or profits to acquire. Because if I've got Frank LaRosa, who's $1 million producer, and Joe Smith, who's $1 million producer, and Jane Doe, who's $1 million producer, and they're all on a 5-year glide path, well, that means for the next 5 years, I'm going to be able to continue to acquire more and more businesses with my free cash flow of the business.
Yeah, and that's an interesting philosophy because I think a lot of advisors would be like, well, I want to buy the whole thing now so I can grow it and get all, basically
Yep.
get all that growth, right?
Yep.
And so that probably speaks to your point about if you're making it all about cash flow today, it's probably going to be more difficult for you versus the way you're looking at it is really building long-term value for your company.
Yeah, and what we're doing too, Frank, is we're aligning we're aligning interests. So really, I'm in a partnership with that advisor in my example for 5 or 6 years. So I didn't buy it all. In my example, I bought half. So therefore, I'm entitled to half of the profits. And guess what? They're entitled to half of the profits, right? So it's more of an earn out over a period of time. It also it mitigates your risk a little bit as well, right? Because you're growing your top line, you're not fully incorporating or integrating all of the profitability, but 2 or 3 years later you're going to buy more of it and more of it, and it works.
So you'll have time to improve that bottom line over time.
Well, so you're improving it, you're building a partnership, so the trust and the retention is better. But what at the end of the day, what you're also doing is that seller, right, who isn't really ready, like what they're able to do is they're able to kind of, you're almost getting married, right, without the full commitment. Does that make sense? So, when someone gets cold feet, you mentioned a minute ago, a lot of, sellers get to the table, and then because the advisor is pushing them too hard on price, or I need you out of here in 12 months, or I'm going to make these changes, they run away. And sometimes they sell it to somebody else. Sometimes they might just go, I'll just keep running this business myself. I can't find the right buyer. In this case, I just think your odds of easing someone in and letting them dip their foot in the water before they dive in and say, I'm retiring. And think about your clients, right? For the advisors out there, how many clients are like, I'm going to retire when I'm 62. They come back and see him like, it's fun. I like the guys at work or the gals at work, and I'm not really ready to go. I got a good project. I'll retire at 63. For it to become 64, 65, my pension, I'll get another 1% every year I stay. So why not?
Right.
Same thing for advisors, right? And letting them sell some of it as opposed to all of it. What you're doing is you're kind of locking yourself in there, right? But at the same time, you're allowing them to have a much longer glide path, which is really important for their own psyche, because a lot of times they're not really ready to retire, even though they're talking to you.
Yeah. Okay. Listen, that was an M&A Masterclass. I'm going to call that. I'm going to officially call that a masterclass.
I'll take it.
I appreciate it. For those again that are listening, he knows what he's talking about. He's hundreds of them. We've done, I think, over 5 or 6 this year. We have a couple of big ones already lined up for next year, and so you know what you're talking about. If somebody wants to, if someone's listening to this and they are interested in selling their business and they're like, hey man, I like what this guy has to say, how do they reach you aside from coming through us, which is Elite Advisor Successions, which is owned by Elite Consulting Partners? Obviously they can go down that road, but how do they, if they want to talk to you about this, how do they go about doing that?
Yeah, easiest thing is probably just to hit me up on LinkedIn, Frank. So my name, Jonathan Kuttin, Kuttin, and just hit me up on LinkedIn, instant message. Is that what it's called? Instant message or direct message, whatever that
DM,
is.
yeah.
And I'll get back to you. If you just Google me, you can get me at my company, Kuttin Wealth Management, and I'm pretty easy to find out there.
Okay, and I think the other thing that you had offered once before, when we do have a lot of buyers in our program, sometimes they have a hard time mentally getting over some of these things. You've offered to have speak to some of these advisors that are part of our Elite Advisor Successions buyer program. So we appreciate you be willing to do that, taking a couple calls. That would have to go through me. I wouldn't want you to get inundated with phone calls. So obviously, if you're interested in that, if you are interested in becoming a buyer and learning how to do that, and are interested in our services, you can give me a call at 856-316-4651. You can also DM me, Frank LaRosa, obviously, on LinkedIn and Instagram, which is frankLaRosa.elite.
Everywhere on social media.
I'm not, I'm not on Twitter or X, whatever it's called. I just haven't been. I think we're on there. I think I have an account, but it's just not where I spend my time. But I am up to 286,000 followers on Instagram, so that's pretty cool.
I think it's just the good looks, man. I don't know. I think it's the good looks.
I think it's the cars.
Could be the cars. Cars are the good looks. One or the other.
Well, yeah. Anyway, listen, John, it was awesome. I learned a lot actually, which was very helpful to me as well, which is why I know you're always a great guest. So I appreciate your time. Thanks a lot. Have a great rest of the year, and here's to doing some deals with you next year.
You got it. Looking forward to it, Frank. Thanks everybody for indulging me today.
Thanks a lot, John.
Thanks for listening to Advisor Talk with Frank LaRosa. If you're looking for more advice or solutions on any topics relating to the financial services industry, or just want to subscribe to our podcast, head on over to eliteconsultingpartners.com/podcast.